SIP or PPF? Which one actually builds more wealth over 15 years? Some say PPF is safe and reliable, a government backed scheme with fixed returns. Others argue SIPs have historically delivered better returns through market growth and compounding. But which one is truly better for long term wealth creation? Let's break it down step by step. Hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So first we will understand SIP and PPF in this video. Like, what are they? What is SIP? SIP is a systematic investment plan, which is a way of investing in mutual funds where you put in a fixed amount regularly, like monthly, quarterly or yearly. Over time, your investment grows through compounding and market appreciation. It gives you market linked investment returns which depend on the stock market performance. And you also get flexibility because you can increase or decrease or even pause your SIP anytime. And you get higher historical returns, on average 12% per year over the long term. Sounds great, right? But let's compare it with PPF. What is PPF? PPF is a public provident fund, which is a government backed savings scheme that offers stable and guaranteed returns. Here you have a fixed tenure of 15 years and the interest rate is set by the government. Currently it is at 7.1% per annum. It is 100% safe, no market risk, and there are tax benefits under section 80C, plus your returns are completely tax free. So one offers stability and safety, the other offers higher growth potential but with market risk. But which one actually grows your money faster? Let's do the math. Let's assume you invest 1,50,000 per year in both SIP and PPF. If you take a look at the SIP's investment calculation, 1,50,000 per year in SIP is equal to 12,500 rupees per month. So your total investment over 15 years would be 22,50,000. In an expected annual return of 12%, your final corpus would be 59,49,142 rupees, and your total capital gains alone would be 36,99,142 rupees. And if you now take a look at the PPF investment calculation, 1,50,000 per year in PPF, in that the total investment over 15 years would be 22,50,000. So PPF's current interest rate is 7.1%. So final corpus would be 40,68,209 rupees and the total interest earned would be 18,18,209 rupees. If you compare this investment in terms of aspects like total investment, the total investment we had made in SIP and PPF is same, like 22,50,000, 22,50,000. But the capital gains you received in SIP would be 36,99,142 rupees, whereas in PPF it would be 18,18,209 rupees. So the final corpus is in SIP is 59,49,142 rupees. In PPF it would be 40,68,209 rupees. So in the risk level, if you take a look at SIP, it is high because it is market linked, but in PPF it is low because it is government backed. In terms of liquidity, it is high because you can withdraw anytime in the case of SIP. But in the case of PPF, it is low because it has a lock-in period of 15 years. And if you take a look at tax benefits, SIP has an LTCG tax of 12.5% above 1.25 lakh gains. And in PPF, it is fully tax-free. And in terms of compounding power, it is high because of market growth in SIP. It is moderate due to fixed interest in PPF. And in terms of flexibility, in SIP you can modify your investment amount. In PPF, it has a fixed annual contribution. So clearly, SIP builds a much bigger corpus than PPF. But does that mean SIP is the better choice for everyone? Not necessarily. Let's discuss risk versus reward. If you take a look at SIP, it has higher growth but with market risk. You see, the stock market is volatile. Returns fluctuate over time. While historical SIP returns average 12% per year, they are not guaranteed. SIPs are ideal for long-term investors with a higher risk appetite. The longer you stay invested, the higher your chances of great returns. So a pro tip would be SIPs benefit from rupee cost averaging, meaning you buy more units when markets fall and fewer when markets rise. So here it will average out the cost of buying and selling. So what if you prefer safety over high returns? In that case, PPF is safe but with lower returns because PPF guarantees returns but at a lower rate. The interest rate of 7.1% is set by the government and revised quarterly. So locked in for 15 years, here the liquidity will be low. Maturity amount is fully tax free, unlike SIPs which may have LTCG tax. So it is ideal for conservative investors who prioritize safety over high returns. Now that we have compared returns and risk, let's talk about something just as important: tax benefits and liquidity. After all, what's the point of high returns if taxes eat into your gains? And what if you need to access your money sooner than expected? Let's break it down. So in terms of tax benefits, in the case of SIP, it is taxable only at withdrawal. So LTCG gains tax is 10% above 1 lakh per year, and in terms of PPF, it is fully tax free under EEE. And in terms of liquidity, in the case of SIP, you can withdraw anytime. Exit load may apply, but it depends on the fund option you have chosen and what is the time period of the exit load. It depends on that. But in the case of PPF, locked in for 15 years, meaning partial withdrawals are allowed only after 6 years. In terms of return, in the case of SIP, market-linked returns can give you an average of 12% if you choose to invest for a long-term period. In the case of PPF, it has a fixed return of 7.1%, which is also subjected to government revision. And in terms of risk factor, in SIP, the risk is high because it depends on market performance. And in PPF, it is low because it is a government-backed security. So who should invest in which? In SIP, investors seeking high returns but willing to take risk can invest in that. But in PPF, if you are a conservative investor preferring stability, then you can invest in that. Because PPF is 100% tax-free, contributions, interest and maturity amount all are exempt from tax. SIP gains above 1 lakh per year are taxed at 10% under LTCG. So in terms of liquidity, SIP wins. You can withdraw anytime, though some mutual funds have an exit load if you redeem yearly. PPF on the other hand locks in your money for 15 years. So if you need funds before that, you can only make partial withdrawals after 6 years but with restrictions. So these are something that you need to remember before deciding to invest in anything. So which one should you choose? The best choice depends on your financial goals and risk appetite. Like, ask yourself, do you want higher returns and can handle risk? Then SIP is the way to grow. But if you prefer safety and tax-free guaranteed returns, PPF is the better choice. But what if you want both, like growth and security? So why not mix both? You can invest a portion in SIP for wealth creation and another portion in PPF for risk-free savings and tax benefits. This balanced approach gives you the best of both worlds, high growth plus stability. So for long-term wealth creation, SIP clearly wins, delivering a much larger corpus in 15 years. So what is the final thoughts? SIP or PPF? For long-term wealth creation, SIP clearly wins, delivering a much larger corpus in 15 years. For tax efficiency and risk-free savings, PPF remains a strong choice. But the real question is, which one is right for you? Your risk tolerance, financial goals, and tax situation all plays a role in this decision. Do you need expert guidance? Then making the right investment decision isn't always straightforward. That's why a certified financial planner can help you to analyze your financial situation, to set realistic goals, and to build a well-balanced investment strategy. Whether it is optimizing returns through SIPs, ensuring tax efficiency with PPF, or striking the right balance between risk and security, a CFP can help you make the smartest choice. So, what's your investment style? Do you prefer higher growth with risk or steady returns with security? Let us know in the comments below. And do you want a personalized investment strategy? Then click the link in the description to book a free consultation with one of our certified financial planners today. Don't forget to like, share, and subscribe for more smart investment insights. Thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.